Okay, let's look at the remaining chapters here. Remember, in these chapters, most of the things we've already covered. So I want to show that the topics that exist in these chapters we have covered in one or other topics, and most of them are just from F2 level. So I would not spend time on it. Okay, so we have Halo method here. You already know this in F2 level. I will do questions on it if they are in the kit. Otherwise, it's not something we can look at. Learning curves, the topic before this one we studied. And then expected values in budgeting. The way you use expected values here is exactly the same as we studied in risk and uncertainties. Budget standard costing. Standard costing, I already have a video made about it, a small video. You could look at that. I will attach a link to this video. The type of standards, and so we will cover the things that I didn't explain in that video. This is actually F2 level topic as well. So uses of standard costing. Why is it important to use standard costing? One thing is it is used as a control device. Sometimes they use the term yardstick. So it is something with which we measure performance, we control performance. An example of that is variance analysis. In variance analysis, you saw we were looking at actual performance in relation to the budgeted performance. And that budget was standard. To value inventory, sometimes we use standard costing to value inventory when actual cost is not known, because it is easier, and usually using standard costing means that the valuation of inventory is stable and our pricing system is stable. It helps in setting budgets. Remember, the component of the budget is standard, and sometimes when we say budgeted performance or standard performance, it means same thing. To enable principle of management by exception. Management by exception means only focusing on exceptional things that are they needs focus. For example, material things. So we could attach a standard level of materiality, and if a performance is outside that standard level, then we would focus on it. Otherwise, if everything is going as it should be, there is no need to focus on it. To provide a prediction of future costs for use in the decision making. Remember, standard costs are a way of future costs. Obviously, they are not going to be 100% accurate, but it is something, a starting point. To motivate management by providing challenging targets. You will see in the video that I will attach, there are different types of standards, and each of those standards have different level of motivation, especially ideal standard and attainable standards. To provide guidance on possible way of improving efficiencies. So when we have a standard and we look at actual performance, if the performance is not according to the standard, we can help motivate them to improve their performance. These are the type of standards which I've explained in that video. And then flexible budget, fixed budget, I already explained. Next, variances. Variances analysis, advanced variances I explained, and I attached a basic variances video in that video, so you can look at both of those, and I explained reason for the variances as well. Okay, remember, not all variances are important or needs our focus. Only significant variances need our focus. And what makes a variance significant? One thing is materiality. If it is larger in volume, it needs our focus. If it is something small variance, it doesn't need focus. Controllability. If it is something that we can control, then it should have our focus. Otherwise, if the department which has variance did not have a cost in control, then it would not be something we would look at. Cost versus benefit. If we look at the variances and we investigated what would be the benefit that it brings us versus the cost of investigating and focus that we are giving. Interdependence. Maybe one variance is caused because of another variance. So it is not important to look at them in isolation. We should look at them together, like they said here, price and usage. When your price is favorable, usually your usage would be adverse. I have explained this in the basic variances video. Causes of variance: efficient, inefficient operation. If operations are efficient, you will have favorable variances. If they are inefficient, there will be unfavorable. Measurement errors. Maybe the performance that we actually did, we didn't measure it appropriately. That's why there is variances. Out-of-date standards. Standards are not update, which means it could be planning variance. Random chance or fluctuation. Random, unexpected things that we didn't believe will occur. And then there are types of variances. Planning and operational. I already explained much about it in that video that I worked. Okay, and they have explained here usually who is responsible for which variances, and they're not something difficult to understand, but remember, focus on the question. Maybe in that question it is specifically told who is responsible for which variances, so that person would be responsible. Otherwise, usually for sales price and volume, sales manager would be responsible, and for planning managers would be responsible. For material price and usage, production manager, for price, purchasing manager would be responsible. For usage, production manager would be responsible. For labor rate, HR would be responsible, whoever is responsible for deciding the rates. Okay, behavior implications, objectives of budgetary planning and control. So why do we have budgets and control system? The main purpose: ensuring that organizations' objectives are achieved. Remember, budgets are those objectives divided into plans. We explained that, we studied that in the previous video. Compel planning. Compel planning means encouraging people to make plans. If you ask people to make budgets, in making those budgets, they will plan as well. Communicating ideas and plans. Through budgets, the top management communicates idea to the lower management. Coordinate activities. One department is linked with another department, like sales department coordinating with production department, so that overall budget can be achieved. Provide a framework for responsibility accounting. Responsibility accounting means when you give someone authority, they have responsibility, and then you ask for that, is called responsibility accounting. So with authority comes responsibility, with responsibility comes responsibility accounting. So when you give someone budget, they are responsible for that, and you ask about that, it becomes responsibility accounting. Establish a system of control, variance analysis. We compare actual with budget. Motivate employees to improve their performance if they have, for example, adverse variances. Negative effects of budget. Remember, budget have advantages as well, but it doesn't mean everything is advantage. There are disadvantages related to budget as well. At the planning stage, managers may fail to coordinate plans with those of other budget centers, especially if they are budgets, bottom-up budgets, which means that each department's manager is responsible for making his own budget. What will happen is they would not consider other departments. For example, sales department is making his budget, but it is not looking at whether it is possible to produce that much unit or not. There may be budgets, like I explained in incremental budgeting, that management could include slacks into budget. When putting plans into action, Minimal cooperation and communication between managers. One manager is looking to achieve his own performance. Another department manager is looking to achieve his own performance. They're not looking at the collective goals of the whole organization. Managers might try to achieve targets but not beat them. They would just do enough efforts so that the targets can be achieved, even though according to the conditions it might be very easy to do better than the budget. Why would you not want to do better than the budget? Is because you don't want next year's budget to be complicated. Using control information and then in variance analysis, resentment, managers seeing the information as part of system of trying to find fault with their work. One thing is they would not accept. They would say, okay, this variance is actually not adverse. Another thing would be if you give them adverse variances, then they would believe that they are being judged. Skepticism of the value of information if it is inaccurate, too late, or not understood. Maybe the information is provided very late, or maybe it is inaccurate, or maybe it is not understandable. So that means it will not be effective. Okay, TQM just-in-time production system we already studied in the beginning chapters, I believe. Okay, problem with standard costing. We have standard costing. Standard costing, remember, can be used in budgets. They're used in variances. So what are the problems with it? Concentrates on narrow range of costs. Maybe, remember, we had standard costing only for material, labor, fixed overheads and variable overheads. Maybe there are other costs as well for which there is no standard. Too much emphasis on direct labor cost and other short-term variable cost. We're not focusing on other long-term costs like marketing and stuff. Relies on repetitive operation and homogeneous output. So standard costing can only be established for things that are repetitive. They are done the same every time. Business environment is increasingly dynamic and unstable, because of which standard costing will have very less benefit. Information produced is not sufficient timely. Or maybe we produce standard costing information, but it is very late to use that. For example, in our budgets, or maybe pricing our products. So why is it still used? Organizations still need to plan and quantify budgets, even though they say something is better than nothing. Cost and mix changes from plans still relevant. I don't know what that means. Use standards as starting point and cost construction for new product. Using standard costing, we can find the cost of a product. Like in target costing, we find the selling price, we minus a profit from it. It gives us a target cost. And then we look at the specification of that product, and looking at that, we can establish some form of a standard cost. Used for product pricing, like it said here. Trends can be monitored over time. So using standard, we can see whether, remember, we regularly update standards. If there are massive variances, then we should update standard. And when we make standard every year, we could look at it over years, like we do that with historic standards. We look at the historic standard and we see where we were and where we are now to look at the trend. Accounting valuation, we could use standard costing to value our inventory. Okay, participation, budget setting styles. There are different ways in an organization's budget can be made. One is imposed, which is top-down budget. In top-down budget, the top level makes the budget and they give it to the lower level, and lower level has to achieve it. It would actually create demotivation, but it will be used specifically in a situation when a company is going through a hard time and it doesn't want to give any freedom to the lower management. Participation is bottom up. Lower level make the budget and they send it to the top level to coordinate and to agree. Negotiated top level makes the budget, they give it to the lower level, and then lower level gives their comment, and those comments are considered in it as well. So advantages of participative approach and disadvantages means advantage of participative become disadvantage of imposed, and disadvantage of participate becomes advantage of imposed. So what are advantage of participative approach or disadvantage of top-down approach? More realistic budget. If you involve the lower level in making budgets, the budget would be more realistic. Coordination, morale and motivation improved. Morale will be improved because they are the budgets, they are the plans that are involved in. The coordination would be improved because they will work through discussions, but not as much as in the top-down, the coordination part. Increase management commitment to the objective. Because it is a budget that they made, they will be more committed to achieve it. Disadvantage, more time consuming because agreement between departments and they making individual budgets will take a lot of time. Budgetary slack will be introduced. Does not suit some employees. Some employees don't like freedom. They want to be told and they will do something. So they don't want freedom. They don't have decision-making capacity. Performance management information systems. You studied these chapters have been actually transferred to the first section. We've already studied them there. Sources of information as well. Okay, performance management in private sector organizations. Remember, private sector organization means profit organizations. We have financial performance indicators and non-financial performance indicators. Financial performance indicators are everything to do with numbers. Non-financial performance indicators don't involve numbers, and if they are involve numbers, usually the purpose is not financial. Financial performance indicators are the ratios that you studied in F3 level, you studied them in F2, you are studying now in F5. So we had profitability ratios, profit margin, return on capital employed, asset turnover, liquidity ratio, current ratio, quick ratio, account receivable days, inventory days, and account payable days. And then we have risk, gearing, and interest cover. So I will try to do one video about ratios. Otherwise, there isn't anything new that you study here. The way you calculated them in F2 and F3 will be the same here. Some ratios in management accounting, only one or two ratios are different, otherwise they're exact same thing. The important thing here is the non-financial performance indicators. So non-financial performance indicators look at a wide range of variables. These ratios that you will see, there are few ratios that you see in every chapter. You actually get bored of these ratios. But the thing is, there are these few measures that we look at in financial accounting and management accounting. But non-financial performance indicators can be many things, and they look at a wide range of things rather than looking at profitability or liquidity or risk. Provides information on quality and customer satisfaction. Quality is an example of non-financial performance indicators. Financial performance indicator would be profit, for example, and then non-financial performance indicator would be quality. If you have reduced your quality to make profit, what will happen? Long-term performance will be effective. Customer satisfaction, you want to make sure that your customer is satisfied. You are not just selling them the products to have a customer loyalty. Better indicator of future prospects. Non-financial performance indicators in short term, there would be costs that we usually incur, but they secure our future. They have long-term view in mind. These ratios that we have here, they mostly look at short-term, usually year basis. Can be provided quickly and tailored to the circumstances. We can have many non-financial performance indicators relating to many issues, but ratios are just a few things. Current non-financial performance is often a guide to future financial performance. Now, non-financial performance indicator doesn't mean you have to compromise on the financial performance indicator. Non-financial performance indicator actually will give you financial performance in long term. If you satisfy your customer, what will happen? He will regularly come to you, and in the long term, your profit will be increased. Factors to consider whenever we are looking at financial or non-financial performance indicators, any measure that we want to find, we have to look at the benefit versus the cost. But the problem with this is usually we don't know how much benefit something is going to give us if we haven't incurred cost on it. Performance must be measured in relation to something. The ratios you see, most of the ratios are not meaningful by itself. Absolute ratios are meaningful in itself, but relative measures, and most of the ratios that you see are relative measures. They don't give meaning without comparing to something. You either comparing with your company in the past, or you compare it with a target, or maybe you compare it with another company in the same industry. Must be relevant and fair. Relevant means it is related to, for example, you're looking at the performance of a department, return on investment, for example. Relevant would mean that you consider the cost that would be incurred by that department. And when it is relevant, it would be fair as well. Need responses. Just calculating ratios is not beneficial. When you have calculated performance, actually responding to that is also very important. Must be monitored on a regular basis. If you just look at it maybe only just a year or maybe every 2 years, you're not looking at it regularly, then it will not be as much effective. When you regularly monitor someone with your study, for example, if you regularly monitor your study, you have a good chance of progressing. Use a variety of measures. Rather than using a few measures, try to look at the performance of the company or department in many ways possible. Short-termism. Short-termism is when you try to achieve the short-term performance of the company and sacrificing the long-term performance. That usually happens when the bonus of management is based on short-term performance, like profit, for example. Examples of short-termism would be protecting short-term cash flow and profit by burning capital expenditure. You don't want to invest in an asset even though you need it very much, because the quality that is produced by the current machine is not competitive in the market. But you don't want to spend money, because spending money would mean the cash is gone, and also that would come as a depreciation. So you are only focusing on the current performance. Saving costs by cutting research and development. Research and development might or might not give you benefits, but if you don't spend on research and development, what will happen is your future profit would be sacrificed, because your competitor would be spending money on research and development, and they could go ahead, like what happened with Nokia. So if you are number one, you will not always be number one. You should try to be number one by doing research and development. Reducing quality control, reducing quality because quality would incur cost. Customer service or training to cut costs. Method to encourage long-termism. How can you make sure that the management is focused on short-term? Obviously, short-term is also important, but they are focused on long-term as well. Make short-term targets realistic. If you make short-term targets easier to achieve, And you don't judge your employees on short-term targets. They will focus on long-term, which is the next thing. Providing sufficient management information. So giving information to the management about the short-termism, if they're doing it, and then motivating them, showing them the benefit of long-term view. Link managers' reward to the share price. If you link the managers' reward to the share price, what will happen is they will try to make the company better. And when company is better, shareholders or market realizes that, and the share price of the company could increase. But remember, this is also not a very good measure when you study financial management, advanced financial management. You would see share price is also not very accurate measure without effective control. But now, to encourage long-termism, share price could be an option. Set quality-based and multiple targets. Don't just have a target of how many units you are selling. You could have a target of how many units you are selling and how many customers are satisfied. Next, we have balance scorecard. Balance, it is like scorecard of a company. So balance scorecard is the idea that a company shouldn't focus on one thing. Company should focus on many things, and they should focus on all of these things equally. It says that there are 4 major things that a manager or a company can focus on. One is customer, another is internal, another innovation and learning, and next one is financial. So customer perspective is focusing on the customer, the price that they want, the quality that they want, the time that they want a product at. Internal is looking at the information organization internally, looking at the processes that we are doing. Maybe there is a way of developing it, looking at the staff we have employed. Maybe there is opportunity to train them. Innovating and learning, remember, it is looking at the outside the organization, seeing what the competitors are doing, being one step ahead of them. Always try to be better. Remember, if you are number one, you're not going to be always number one. So you always need to innovate and learn. And then the last one is financial. Obviously, the purpose of all of these other 3 measures is that we will achieve the financial output as well. Financial output will be one of the main ways that shareholders look at the performances, looking at share price increase and dividend. These are the 2 main things, main ways that return can be improved. So the idea is looking at all things equally, not just focusing on one thing. Obviously, profit organization exists solely for financial reasons, but looking at other things would make sure that that financial aim is achieved as well. Next is building block model. Building block model means basic. In any organization, the basic things are these few things that are explained here. So the fundamental things in organizations are these building blocks. Building blocks, remember, means fundamental things. And it is specifically designed for service organizations. And remember, service organizations are different than product organization because of the qualities. You can remember these qualities using the mnemonic SHIP, which is S for simultaneous, H for heterogeneous, I for intangible, and P for perishable. And then there is another one, no transfer of ownership. Intangible means service doesn't have anything physical. Inseparable or simultaneous, you could say, is service is provided and received at the same time, not like products. Product can be produced, it can be given to customer at a later date, but a service, for example, a haircut. If you want Haircut, you have to be physically present with the barber so that he can give you a haircut. You cannot tell him that take a haircut, I want to take it home. Perishable, usually service cannot be stored. A product can be stored. Variability, quality of product is different every time. You can make a quality of service. You can make a product about the same every time, but service is very difficult to maintain. No transfer of ownership, and with paying for a service, customer doesn't actually own something. Okay, coming to the building blocks. Building block says there are three main things in an organization. One thing is standards. Whenever you are setting standards, you need to make sure individual needs a sense of ownership of those standards, which means they should have a belief that they have that in control. There should be that controllability part in it. Achievable targets should not be very difficult to achieve. If something is very difficult to achieve, then people don't usually do it. Like ACCA, for some people ACCA is very difficult, so the thing is they don't do it at all. After studying one or two papers, when they see it is difficult for them, then they leave it. Equity. Equity means fair. They should be fair, which means not very difficult and not very easy. And then obviously, when you are setting standards, when those standards are achieved, you are giving employees rewards. So there should be some qualities with rewards. One thing is they should be clearly understood. They should know what the rewards are. They should motivate individual. Reward should be something that an employee wants, something that an employee needs. Controllability. Managers should be able to control their area of responsibility, which comes in the standards as well. And then we have dimensions. We can look at the performance of the company through different dimensions. One is comparative performance. Our performance should be something that we can compete with in the market. We should look at financial performance, ratios analysis. We should give quality of service. Our service should be better. We should have flexibility. We should always be able to change to the environment. Resource utilization. We should try to utilize our resources as much as possible. And then innovation. We should not be the same. We should try to do the service in new ways possible. For example, a barber trying to find new, innovative haircuts. Divisional performance and transfer pricing, I will do this in another video. Okay, further aspects of performance management. Non-for-profit organizations, remember those organizations whose objective is not mainly making profit, but it doesn't mean they don't make profits. They can make profit, but it is not the main purpose that they work for. That means that those ratios that we have for profit organizations are of limited use to a non-profit organization. Non-profit organizations look at other measures as well, non-financial performance measures, but they have one thing that almost every non-profit organization looks at, which is value for money, or VFM. VFM, or also known as 3 E's, efficiency, effectiveness, and economy. I will first focus on economy. Economy is doing something with the lowest cost possible. It looks at input. Whenever we have input, that input should be of the lowest cost possible. If it is labor, if it is material or resources that we have, we should try to spend as much lower as possible, but obviously the quality should not be sacrificed. Right quality at the lowest cost possible. And then we have efficiency. Efficiency looks at output. When we have input at the lowest cost, which is economy, then that input should be utilized in the most efficient manner as possible so we can achieve as much output as possible. And third thing is effectiveness. Effectiveness is whatever the organization is working for, whether their objective is achieved or not. An example would be, let's say, police department. The main purpose would be stopping crime. Is it actually stopping crime or not? Problem with performance measurement that we have for profit organizations, multiple objectives. Non-profit organizations have multiple objectives. They don't have specific objective. They are not just like profit organizations. The profit organization's main objective is profit. But obviously those other objectives will help them achieve that. Measuring outputs in non-profit organizations, usually it is very difficult to know what the outputs are. In profit organizations, output could be sales units, it could be production units. Lack of profit measure. When there is no profit, then an organization is very difficult to look at, to see its performance. Nature of service provided. Maybe the service that they have provided is something that is new, and it is very difficult to measure whether it is being provided well or not. Financial constraints. They are not able to do many things because they are not making profit. Because they are not making profit, it means they don't have as much money. If they don't have as much money, it means they will not be able to do many things. Political, social, and legal consideration, they are under the effect of these things. So non-profit organizations are usually under the influence of many of these things. Solutions. Judge performance in terms of input. If input is good, output would be good. Use experts, subjective judgment. So usually every non-profit organization would be very different, so we need someone who is expert. Use benchmarking. You could use targets for them to achieve. If you don't know what good or bad is, you could think of what they should achieve. Use unit costs, quantitative measures. If they have output, you could look at the cost per unit, like in VFM. Okay, obviously, when we shouldn't only focus on inside of the organization. To be competitive, to be prosperous, we need to look at the external environment as well. External environment, we have stakeholders, which you already studied in F1 level, so I will not go into that. Market conditions, economic growth. Maybe your performance is bad because the economy is not growing, or maybe your performance is better because the economy is growing, not because you're doing better than your competitors. Looking at the local economic trends means the same thing. You have to look at the inflation. Maybe you're selling a product at a price which is lower and your cost is actually increased. So generally with inflation, prices and costs will increase. Interest rates, when interest rates are lower and higher or lower, it affects the demand. Maybe it is not because of your performance being bad. Exchange rates, maybe because of increase and decrease in exchange rate, the demand for your product increases and decreases because of it being expensive or cheaper. Government fiscal policy and government spending, which you studied in F1. Competitors. Look at the competitors, what their pricing strategy is. We saw that in market skimming and market penetration as well. Information on competitors' prices and cost structure. We have to see what the competitors' prices are and what their cost structure is. We need to know their prices because we want to charge as much as they are charging. We want to know their costs because we want to know whether they're actually profitable business or not. If they're not profitable business, then we shouldn't worry about them charging lower price. React quickly to the changing market conditions. And we should be very flexible. If there are any changes in the market, we should change ourselves, be dynamic. Okay, management performance should only include those items that are directly controlled by the managers. We study that in budgets as well. We study that in variances as well. Only those things that they have control of, they should only be made responsible for that. Okay, danger people would concentrate only what is being measured. One of the problem of measurement is something called tunnel effect. Tunnel effect means that there is a saying that I don't remember it exactly, but it's something like what gets done is what is being measured, or what is being measured gets done. So if we measure a few things, then only those few things will be done. There will be other things that are important, but because they are not measured, they will not be done. A conflict between individual and corporate goals may be departmental, for example. A department has a specific goal. They want to achieve that goal, even though if the goal of the whole organization is not achieved. Difficult to devise performance measures relating specifically to a manager's performance as a manager. It would be very difficult to measure whether a manager is a good manager or not if there aren't very good measures to measure his performance. Reward schemes can encourage dysfunctional behavior. Dysfunctional behavior means when a manager only focuses on his own department. So whenever we give production department a budget of production, they will try to achieve that budget, even though if they know that the sales department will not be able to sell as many units. Okay, there's nothing else. So next I will look at transfer pricing and maybe a question on ratios. I don't believe ratios is very important. I will do question in KIT, but I don't have to specifically focus on ratios analysis. So next topic, transfer pricing should be the last video.